The truth about index funds nobody tells you. Imagine two people invest the exact same amount of money in the exact same year into the exact same market. One of them ends up paying almost nothing in fees over the next 30 years. The other one quietly hands over hundreds of thousands of dollars, not to the market, not to bad luck, but to fees they didn't even know they were paying. Same market, same returns before fees, wildly different outcomes. And the difference isn't skill and it isn't luck. It's something most people never even think to check. In this video, I'm going to explain what index funds actually are, why they've quietly become the default choice for millions of long-term investors, what the research says about active management versus passive investing, and maybe more importantly, where index funds actually fall short. Because no, they are not perfect for everyone. Welcome to Finance Explained Simply, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. I'm not a licensed advisor, and nothing here is a recommendation to buy or sell any specific product. Think of this as a map, not a set of directions to your house specifically.
So what exactly is an index fund? Let's strip away the jargon for a second. Think of it like a scoreboard for an entire sports league, not one player, the whole league. If you wanted to bet on professional basketball as a category, rather than picking one all-star who might get injured next season, you'd basically want a bet that tracks the performance of every team combined. That's an index. It's not one company. It's a basket that represents an entire slice of the market, like the S&P 500, which tracks 500 of the largest publicly traded companies in the US. An index fund is simply a fund built to copy that scoreboard as closely as possible. It doesn't try to guess which player, which stock is going to outperform. It just owns a little piece of everyone on the board, in proportion to their size. No stock picking, no manager trying to time the market, just mirroring the index. That's exactly how index funds work. They're not smart, they're not dumb, they're just a mirror.
Now, here's where people get confused, because index fund isn't one single thing. Let's break this into categories. First, there are broad market index funds. These track something huge, like the total US stock market or the S&P 500. Providers like Vanguard, Fidelity, and BlackRock's iShares all offer versions of these, usually with expense ratios somewhere between 0.3% and 0.4% per year. On a $10,000 investment, that's about $3 to $10 a year in fees. Second, there are sector or thematic index funds. Tech, healthcare, clean energy, whatever slice you want. These are narrower, so they carry more concentrated risk, but the fee structure is usually similar, sometimes slightly higher, maybe 0.110% to 0.410%. Third, and this is the one people mix up constantly, there's the difference between an index fund and an ETF. An ETF, or exchange-traded fund, can be an index fund, but it trades throughout the day like a stock. A traditional index mutual fund only prices once a day, after the market closes. Different wrapper, often the same underlying strategy. And then, for contrast, there's the category people are usually comparing index funds against, actively managed mutual funds, where a professional manager tries to beat the market by picking specific stocks. Those typically charge somewhere between 0.5% and 1.5% per year. And some hedge funds famously charge a 2 and 20 structure, 2% of assets annually plus 20% of any profits. That fee gap looks small on paper. It is not small in practice.
Here's the catch. Over long periods, that small percentage compounds into an enormous difference. This is where the SPIVA research comes in. That's the S&P indices versus active scorecard, which has tracked for years what percentage of actively managed funds actually beat their benchmark index. Repeatedly, the data has shown that the majority of active large-cap fund managers underperform the S&P 500 over 10 to 15-year periods. Not a slim majority, often well over half, sometimes over 80%, depending on the category and time frame. There's also the famous bet Warren Buffett made in 2007.
He wagered that a simple, low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years, after fees. By the end of that decade, the index fund had won, and it wasn't particularly close. Why does this happen? It's not that active managers are incompetent. Many are genuinely skilled. It's that fees are guaranteed and outperformance is not. Every year, the manager takes their cut whether they beat the market or not. Over 10, 20, 30 years, that guaranteed drag becomes very hard to overcome, even for smart people.
So let's talk about the mistakes people make around this whole topic, because there are a few big ones. Mistake number one, assuming expensive means better. A lot of people psychologically link a higher fee to higher quality, the same way they might with a bottle of wine. In investing, higher fees just mean you need higher returns just to break even with a cheaper alternative. Mistake number two, chasing last year's winning fund. An actively managed fund that outperformed last year gets a flood of new money the following year, and then, historically, tends to regress toward average or worse. Past performance really doesn't reliably predict future performance here. Mistake number three, thinking index funds are risk-free. They are not. If the entire index goes down 30%, your index fund goes down roughly 30% too. Index funds don't protect you from market-wide crashes. They just make sure you're not paying extra for a manager who probably couldn't protect you either. Mistake number four, ignoring that index funds can still be concentrated in disguise. Because the S&P 500 is weighted by company size, a handful of massive companies can end up making up a large chunk of the index. So you might think you're diversified across 500 companies, when a big portion of your return is actually being driven by just a handful of giants. Let me introduce you to two investors. I'll call them Active Andrew and Index Irene. Both start with $50,000 at age 30. Andrew puts his money into an actively managed fund, charging 1.2% per year, hoping to beat the market. Irene puts hers into a broad index fund, charging 0.05% per year, accepting that she'll simply get the market, nothing more, nothing less. Let's say the underlying market returns 8% a year for both, before fees, over 30 years. Andrew's actual return, after fees, comes out closer to 6.8%. Irene's comes out closer to 7.95%. Run that difference out over 3 decades, and Irene's account ends up meaningfully larger, often somewhere in the range of 30 to 40% more, purely from the fee gap, assuming similar underlying performance. Andrew didn't make a bad decision because he's unintelligent. He made a decision that felt reasonable, pay for expertise, without fully seeing how fees compound silently in the background, year after year, whether the fund wins or loses. This is a simplified, illustrative example, not a guarantee of any specific fund's future results, but the mechanism behind it, fee drag over time, is very real and very well documented.
So who should actually consider index funds, and who might it not be for? If you're a beginner who doesn't have the time, tools, or interest to analyze individual companies, and you want broad exposure to the market at the lowest possible cost, a low-fee, broad market index fund is often the simplest starting point for the core of a long-term portfolio. If you're someone who enjoys researching individual companies, understands financial statements, and is comfortable with higher volatility from concentrated positions, individual stock picking might appeal to you. But the data suggests most people, professionals included, struggle to consistently beat a simple index over long periods. If you're someone with a very short time horizon, say you need this money in the next 1 to 3 years, neither index funds nor active funds may be appropriate because both are subject to short-term market swings. That's a different conversation entirely, more about cash and short-term instruments. And if you are someone chasing quick, dramatic returns, it's worth being honest with yourself. Index funds are deliberately boring by design. That's not a flaw.
That's the entire point.
So, what's the real takeaway from all of this? Index funds aren't magic, and they're not a guarantee of getting rich. What they are is a low-cost, transparent way to capture the return of an entire market without paying extra for someone to guess which pieces of that market will win or lose. The research, over and over, has shown that beating the market consistently is much harder than it looks, and that fees matter far more than most people realize until they actually run the numbers. I hope this helped you understand index funds a little more clearly, and I hope it gives you a better framework for thinking about fees the next time you're comparing investment options, not as a small detail, but as one of the few things in investing you can actually control. If you found this useful, hit like, subscribe if you haven't already, and let me know in the comments. Do you lean more toward index investing, or do you prefer picking your own stocks? I genuinely like to hear your reasoning either way. Thanks for watching, and I'll see you soon.